I'll ask you two questions. The first question is, let's say a stock is at 100 rupees right now. Okay. And you have done your research and analysis and you think that from here the stock is currently at 100 but it will go till 120. What will you do? Your immediate answer will be that right now it's at 100 and I think that it will go till 120. So when it's at 100, I will buy, and when it goes to 120, I will sell. So the 20 rupee difference will be my profit. Great. Now the second question is, when you thought that the price will increase, so you bought. But what if you think that the price will decrease? Right now it's at 100, but you think that it will go till 80. What will you do? The exact opposite. When you thought that the price will increase, you bought at a lower price and then you will sell at a higher price. But now you think that the price will decrease, so you will sell at a higher price, and when the price will fall, you will buy it. But wait a minute. So you're telling me that you will sell something which you don't own. So in the first case, when you bought this, you paid money, you bought the stocks, so now you own those shares. Then you will sell something which you own, which are those shares. But in this case, in the second example, you will sell first and you will buy later. So when you will sell, you don't own those shares. So you will sell something which you don't own. Is this even possible? Yes, it is possible. How? Let's understand in today's video. Hi everyone, I am Jayasha, and in today's video we are going to discuss a very important concept, which is short selling. Let me start with a story. So let's say that you are working in a company and one day your colleague comes to you and says that he's selling his property and the price is 1 crore. And so why is he telling this to you is that if you might be interested in buying this property, or any of your friends must be interested in buying this property, so he tells you that if you know anyone who is interested in buying this property, please contact me, or like that, right? So you tell him that, okay, I'll ask some people, and if they are interested, I'll contact you. Okay. Now after some days, now me and you are also friends, okay, and after some days I tell you that I am looking for investing 1 crore rupees in some property. So if you know anyone who is selling any property, so please let me know. So you immediately thought that you will connect me and your colleague so that we can do this transaction. But before doing this, before giving the contact details of each other, you remembered that your colleague told to you that he's selling his property, that this thing has been 1 week. So what if that colleague has already found a buyer? Right, so you tell me that, okay, I'll get back to you, I'll ask 2-3 people and I'll get back to you. So the next day you go back to your colleague and you are about to tell him that, okay, you know what, there is my friend who is willing to buy a property of 1 crore, so I'll give you his contact and all. So you are just about to tell him this, and what your friend tells, and before you tell this to your colleague, so your colleague tells you that, you know what, I didn't tell you this before, but I'm actually going through a very bad condition financially, and there's an emergency in the house, and that is the reason I'm selling my property, because I need money immediately in the next few days. So, and I've been trying to give ads in newspaper and all that, but no one is ready to buy this property at 1 crore rupees. So maybe what I'll do is I'll put another ads from Monday onwards that I'm selling it for 95 lakh rupees, and let's see if some people are ready to buy it. So now see the interesting part here. I am ready to buy that property at 1 crore rupees. And from Monday onwards, the seller who actually owns that property, who is your colleague, he is ready to sell that property at 95 lakh rupees. But I am ready to buy at 1 crore rupees today. So now you, as a smart individual, what do you think that this is an opportunity for me to make a quick profit? So what you do is, you make 2 deals. You know that on Monday the price of this property is going to become 95 lakh because the seller is willing to sell that in 95 lakh, right? So you make 2 deals. First deal you make today with me, that okay, you don't own the property actually, but you tell me that, you know what, I own this property and I'm ready to sell it for 1 crore rupees, and you give me all the details, and even I am ready to buy the property for 1 crore rupees. So you make the deal with me that you will be selling me that property for 1 crore. So I'll be paying you 1 crore and you will be selling that property to me. Okay, you don't actually own that property, but you told that you own the property. And you told that the property, the papers and all that we'll do after 2-3 days, right? But the deal is deal is finalized today itself. Okay. Now on Monday, when the price of that property became 95 lakh, what you did is, from the 1 crore rupees you received from me, you gave 95 lakh rupees to that colleague and you bought that property, right? So now you have made two deals. One is to sell that property to me for, and one is, so two deals. One is to sell that property to me, and one is to buy that property from your colleague. So net in terms of property, you don't own any property. You have bought it from that colleague and sold it to me. But you have bought it from your colleague at 95 lakh rupees. But you have sold it to me at 1 crore rupees, right? But chronologically, you first sold it to me and then you bought it from your colleague, right? So you first sold that property to me for 1 crore rupees, saying that you own it. You didn't actually own it, but you said that you own it. Then after that, what you did is, using 95 lakh rupees, you bought that property and you gave that property, you handed it over to me, right? So this difference of 5 lakh rupees is your profit, right? This is exactly what happens in stock market, right? So let's say that right now the price of the stock is at 100 rupees. So we'll take 1 crore rupees as 100 rupees for easier. Okay. So right now it's 10 a.m. So you know that the market is open from 9:15 to 3:30, 9:15 a.m. to 3:30 p.m. Okay. So right now the price of the stock is 100 rupees. Okay. Now I think that the price will go up from here. So I'm ready to buy that at 100 rupees. But you think that the price will go down from here. So you are ready to sell at 100 rupees. So we make the transaction. I give you 100 rupees and you sell that stock to me for 100 rupees. You don't actually own that stock, but you think the price will go down. So you have short sell. You do short selling basically. Okay. Now after that, the price went down till 95. So what you did, you bought. Now you had sold it to me for 100 rupees. When the price went down to 95, you bought that stock from any other investor. You bought that stock for 95 and you covered your position. So this thing is called as squaring off your position. So in the previous example, I told you that what if the price will increase? So let's say the price is at 100 rupees and on the same day the price went at 110. So you bought at 110 and after that you sold at 100. So you bought at 100 and you sold at 110. So first you bought and then at 110 you sold. So when you sell at 110, that thing is called as squaring off the transaction. So that buy transaction which you did first, when you sell, so it is called squaring off the transaction. So similarly here, first you sold at 100 and then when the price went down to 95, you bought it. So this is called squaring off the transaction, right? So this is the concept of short selling. So buy first when the price is high, then when the price, sell first when the price is high, then after that when the price falls, buy it. So you buy at a lower price and sell at a higher price. So the difference is your profit. But chronologically, you sold first and then you bought later. So when you sold it, you did not actually own it. Okay. So yes, this is totally legal. SEBI allows it, but there are some rules which you need to follow. So the first rule is that this needs to be an MIS intraday order. Okay, we'll discuss about types of order in the next video of this series. So it needs to be an MIS order. So MIS is margin intraday settlements. So like the name tells you, it's an intraday order. Okay, so first you sold at a higher price and then when the price fell down, you bought it again. So I told you that when you buy it again, that thing is called as squaring of the transaction. So you need to square off the transaction today itself. You sold the stock today itself because you didn't own it, but you sold it. You short sell it, right? So the squaring off of the transaction should also happen today itself. It needs to be an intraday order. Okay. So I explained to you the concept of intraday and delivery in the second video. So intraday means that if you buy today, you have to sell it off today itself. And if you sell first, then you have to buy it again today itself. This is intraday. And delivery means that if you buy today, you can sell it off after 2 days, 3 days, 1 week, 1 year, whatever. Okay. But intraday, if you buy today, you have to sell it off today itself. If you sell, you have to buy it today itself. So whenever you are short selling means you do not own those stocks, but you think that the price will go down from here. So you sell first and then when the price falls, you will buy. So in that case, it needs to be an MIS intraday. It needs to be an MIS order. It needs to be intraday. Okay, so you need to cover your position or you need to square off the transaction today itself, the day you sold off the share, right? Now let's discuss about what can be the different cases in this case of short selling. Okay, so first case is, let's say you sold it at 100 rupees first and at 10 a.m. you sold it for 100 rupees and let's say at 1 p.m. That is in the afternoon, the price went down to 95. So you bought the stock. So this 100 minus 95, that 5 rupees is your profit. Okay, very good. Now let's say that you sold at 100 thinking that the price will go down from here, but it actually doesn't go down. The price actually increases. The price goes down to, let's say, 105 rupees. Okay, but now, like I told you, you need to square it off today itself. It needs to be an intraday order, right? So now if the price has gone up to 105, so this will be a loss to you, not a profit. So first, if you sold at 100, bought at 95, selling at 100, buying at 95, 5 rupees is your profit. But if you sell at 100 and you buy at 105, so 5 rupees will be your loss, because when you bought, you gave money, and when you sell, you receive money, right? So when you bought it, you gave money which is 105, and when you sold, you received money which was 100. So 5 rupees is your loss, right? And if the price stays same, so no profit, no loss. But actually, so if the price stays same, it stays 100. So you will buy again at 100. So there will be no loss, but obviously there will be those brokerage and transaction charges. So I explained you the concept of break even in the second video of this series, right? So it will be actually a net loss for you if the price stays same. But yeah. So now the most important case here can be, what if you forget to buy it again? So you sold at 100, the price went to 95, but you forgot to buy it, or you did not buy it, or whatever is the reason, you could not buy it. So in this case, what will happen is you will enter an auction market. Okay, so first of all, if you forget to buy it, some brokers will automatically square it off at 310, 320. That depends on the broker. Okay, but let's say that no one is ready to buy that stock. Okay, so no one is ready to sell that stock. Okay, sorry. So first you sold it, so someone else bought it. Now you want to buy it so that someone else needs to sell it. But let's say that no one else is ready to sell at 310 or 320 or whatever is the time of the broker. Okay, so first thing is, if you forget, then it will be automatically squared off by the broker. But broker also, see, if you are buying something, someone else needs to sell, right? If someone else is not ready to sell, what will the broker also do? So let's say in any case that at 3:30 the market has closed and you have not been able to buy the stock back from someone, but you had short sold it in the morning. You had short sold it today. So what will happen is, now 9:15 to 3:30 is the time for normal people like us. Okay, after 3:30 we cannot trade, but from 3:30 to 4 there is an aftermarket. So in 3:30 to 4 the brokers can trade on our behalf. Okay. So now if you forget to buy, or if you are not able to buy in any case, so what will happen is your broker will trade on your behalf. But what happens here is that, let's say you sold it at 100 and now the price is 95. Okay. Now if you forget to buy, so first of all you will face a penalty from SEBI and all. There are all of those rules and all that. So if you want to, save yourself from that penalty, the broker will trade on your behalf. So, but now you are in desperate need to buy because you do not want the penalty, right? So now the seller will take advantage of it. The price is 95, but the seller will tell that I am ready to sell at 110. If you want, then take it, buy it from me, or it's your choice. So now, because you do not want to face the penalty, you have to buy it from 110. So you sold first at 100, and then in the auction market you bought it at 110. So this 10 rupees will be your loss, right? So auction market is a little complex scenario because there are some, so it's better for you to, if you are short selling something, either don't forget to buy it before 3. Okay, some brokers have 310, 315, 320. So either do not forget to buy it back again, or do not place this MIS intraday order in the first place, right? So let's say that you already have shares in your Demat account and you have short sold those. So in that case, even if you forget to buy those shares again, so those shares will be transferred to that buyer. So I know it's confusing. Wait, let me cover it through. So let's take the same example. There are 3 people, me, you, and there's a third person who is your colleague. Okay. So at 10 a.m. You sold those shares to me. Okay. You placed a short sell order, MIS intraday order, right? So you sold those shares to me. So you told me, so I gave you money, and I'll give you money and you will give me shares. So at 10 a.m. what you told me, so you told me that, Jay, you know what, I have sold the shares to you, right? And the market is open till 3:30. So now it's my responsibility that I'll give those shares to you. So wait till 3:30. I'll buy those shares from someone and give it to you, Jay, right? So you'll tell me that, okay, I said, okay, you have sold the shares to me. If I get the shares, there's no problem. So now before 3:30, let's say at 1 p.m, the price falls to 95. You bought those shares from someone and you gave those shares to me. So now I had paid you 100 rupees for buying the share and you gave me the share. So no problem, right? So now the problem will occur if you're not able to buy those shares. So in that case, what you'll say is, see, I was not able to buy those shares, but I already have those shares in my Demat account. So since I promised to you sell that shares to you, you take those shares, right? So I'll say okay, right? So now let me quickly summarize short sell in two transactions. The first transaction you will be selling, and in the second transaction you will be buying. So in the first transaction, let's say the transaction is between me and you. So in first transaction, you are selling, I am buying. The price is 100 right now. So 100 rupees will be transferred from me to you, and shares will be transferred from you to me. In the second transaction, you are buying and someone else, which is your colleague, is selling. But at that time, the price is 95. So at 95 rupees, so 95 rupees will be transferred from you to that colleague, and shares will be transferred from that colleague to you. So if you look at your net position, 100 rupees is incoming, 95 rupees is outgoing. So 5 rupees is your profit, right? And in terms of shares, you will take those shares from that colleague and you will give it to me. So your net quantity will be 0. So if you have seen the T+2 mechanism video, which is my previous video, so you'll know that on day 1, only the money is deducted from the person who is the buyer, and the shares are deducted from the person who is seller. So now today, what will happen is you do two transactions. One is buy and one is sell. So minus 10 shares first when you sold it to me, and then plus 10 shares when you bought it to me. So your net position in terms of number of shares is 0. But in terms of money, plus 100 and minus 95. So plus 5 is your profit, right? So this is the concept of short selling. Now, when can the loss happen? You first sold at 100. You thought that the price will decrease, but the price actually increased to 105. So first it will be plus 100 and minus 105. So minus 5. So 5 rupees will be your loss, right? So I hope this made the concept of short selling extremely clear, right? And one important thing which I told you, but I'll repeat it once again. If you are selling something which you do not have, so if you are short selling something, so first will be that sell transaction from your side, and the second will be the buy transaction from your side. So that buy transaction should happen on the same day. It should be an intraday order, right? And if you forget, then either you will be if you have those shares already in your Demat account, so those shares will be deducted, or if you do not have, then you will have to face the consequences of auction market or penalty, whatever, right? So I want you to remember two cases. The first is, so let's say that the prices of the particular stock is at 100 right now. There can be two cases. Either you can think that the price is at 100 and I think that this will go to 120 or 110. So I think that the price is going to increase. So in that case, you will buy first, and when the stock will reach high price. So at that time you will sell. And the second case is that you think that the price is going to fall. So right now it's at 100. I think it's going to go to 80. So I will sell first and I will buy later. But remember that this sell first and buy later can only happen in intraday, right? Now there's also futures and options. That's another whole advanced concept. So let's not get to that in this video. But so the two cases which I wanted to remember is, the first case is that when you think the price is going to increase, that is called that you are bullish about the stock. And when you think that the price is going to decrease, so that means you are bearish about the stock. So how can you make money when you are bullish about the stock? Buy first, when the price increases, sell it at a higher price. If you are bearish about the stock, you think that the price is going to fall, sell first and buy it later at a lower price. But remember, whenever you are bearish about the stock, and if you are trading in equities, that is in normal shares, not in futures and options, at that time if you sell first and buy later, you can only do that during intraday. Like I told you, MIS, margin intraday settlement. So you have to, after you sell, you have to buy it during the same day, or either you have the shares in your portfolio in your Demat account, like I told you, right? So I hope you got the answer to the video, that whenever you think, so many people think that people can only make money in stock market when the prices of the stock are increasing, when everything is good, market sentiment is good, the economy is doing good. At that time the prices will increase. So everyone think that that is the only time we can make money. But no, even if the price is decreasing, at that time we can make money, provided you have predicted it before, right? So if the stock is at 100 and you predicted it right, that the price is going to decrease, and you have the right amount of knowledge and you know what is short selling and everything, so then you can even make money when the market is not doing good, when the economy is not doing good, but your prediction is correct that yes, the market is going to fall from here, the price is going to decrease. So then you can even make money when the prices of the stock are falling, right? So that was all about this video, and the next video is very important. It is about types of orders. So any of you who is very new to the stock market and he doesn't know about types of orders. So I'll request you to watch the entire video, which is the next video. So I'm sure it will help you a lot. So that's it. That's all about today's video. I'll see you in the next video. Bye bye.